Hello everybody, accounting in 10 minutes.
Let's go.
To understand accounting, you have to understand the accounting cycle, which basically helps you understand the relationship of every step of accounting to the every other step. So you know why we're doing everything and what is the purpose of every step. So I'm going to show you that right now, right here. So you can see the first step in the accounting cycle is the accounting equation. So let's talk about what that is. Accounting equation basically helps us build our concepts. So for example, if owner introduces money into the business, we need to be able to understand which account will increase or decrease, like what is going to be the effect of that transaction. That's what accounting equation helps you understand. And it is by far the most important topic in accounting. It gets overlooked all the time. People think of it as any other topic. It's not. This is the topic that will determine how you understand the rest of accounting. Either accounting is going to be subject that you like, or like most people, hate.
Now if you want to learn the accounting equation in the best way possible, I'll leave a thumbnail of my video that I already made. It's a 15 minutes long video, but it is well worth it. Go watch that.
Now the second step of the accounting cycle, which is the journal entries. What are journal entries? Journal entries are how we record transactions into the accounting system. So accounting equation is to help you build the concepts. Journal entries are how you record things into the accounting system. Now the problem that students have in this topic is, what are debits and credits? How am I supposed to know if something is debit, credit? There's so many approaches out there. This acronym way, there's the increase, decrease way, but those don't really work. If you are going for CPA, you would know that going for those shortcuts never get you fast enough. You're not able to pass the exam. So you have to have a clear understanding of what debits and credit means. Now let me explain in the easiest terms possible. Debits and credits are the language of accounting. If I want to tell the accounting software that my assets are increasing, I have to say asset debit. Because in accounting, there are rules of what debits and credits mean. I'll also leave that right there. Memorize the rules, you'll be just fine. So I hope you can see that assets increase on the debit side, assets decrease on the credit side. However, when we're talking about liabilities, they increase on credit side, decrease on debit side. Similarly with equity, increase on credit, decrease on debit. So you have to make sure you understand the rules perfectly and memorize the rules. Don't do any shortcuts, don't do acronym way. Please stay away from those methods. Now I was about to move to the next step, but why don't I give you an example here. So let's say owner introduced $100,000 cash into the business. What happens? Cash goes up, capital goes up. If you already know that concept, I hope you watched my accounting equation video, you'll have learned it there. But in any case, trust me right now, that's what happens. Okay, I'm not lying here. So what are we going to think about this? So okay, asset, which is cash, is going up, so it will be debit. And capital, which is equity, it goes up on credit. So that's all what journal entries are. That's how you know what is debit, what is credit in each transaction. And in each journal entry, there's one debit, one credit for 99% of the transactions. Of course, there's some transactions that are like more debits and, okay, ignore that for now. For now, what I said, keep that in mind. Okay, so now we have the third step of the accounting cycle, which is the T accounts. Now T accounts, if you're doing accounting for your business, you don't have to really do them. They're done automatically by the accounting software, by the modern, beautiful looking accounting softwares. However, if you're a student, you need to learn how to do T accounts. And please remember, T accounts are how we calculate the total of each account. So for example, of course I recorded the transactions into the accounting software, but how do I know how much total cash I have? How do I know how much total building I have? How do I know how much total accounts payable I have? I can only know that once I do the T accounts and find the total ending balances. Like I said, nowadays accounting software do it automatically, but if you're a student, you would have to do this. Fourth step, which is the unadjusted trial balance. Now what is a trial balance? Trial balance is listing of all of the closing balances of all of the accounts in one single piece of paper. That's all. So we can say the summary of closing balances of all of the accounts. By closing balance, we mean the total of each account is a trial balance. And why we call it unadjusted, you'll see that in the next step, which is adjusting entries. Now, to understand the concept of adjusting entries, we first have to make sure that we understand certain things about accounting. Now, yes, most of the things we record are transactions. Like I purchased a building, okay, I got the building, I paid cash, okay, that's a transaction. However, sometimes things are not transactions, but they did happen and accountant has to record them. Like depreciation, decrease in value of an asset over time because of using it. So of course, once the year passes, the accountant has to record the depreciation on the assets, because obviously now they've been used, they've lost some of the value. So that's kind of what adjusting entries are. They are prepared after the unadjusted trial balance. So that means unadjusted trial balance numbers are mostly correct, but they have not been adjusted for the things that some of the things that might have happened during the year, like depreciation. So just to make sure we're clear, in adjusting entries, accountant will record things that might not have been recorded during the year which actually did occur, like depreciation. Obviously, the other things you can watch my shorts. You can watch my, by the way, when I say shorts, I mean YouTube shorts. And you can also obviously stay tuned for my future videos. I'll be uploading a ton of content, long videos, short videos, you name it, you'll see that. Okay, in any case, after we have done the adjusting entries, now we prepare the adjusted trial balance, where we see all of the correct numbers, all of the adjusted numbers, the correct, let's say depreciation, the correct prepaid expense, the correct unearned revenue, all of the accounts, capital account, every account that has the correct balance, you'll see that in the adjusted trial balance. And now the part that everybody's been waiting for, the financial statements. Since we know the correct numbers now, we can prepare the financial statements. What are the financial statements? Financial statements are basically structured reports about a business. For example, you have financial statement called income statement, which shows the profit of the business by listing out the revenues and expenses. We have the balance sheet, which shows you the assets, liabilities, and equity of a business. We have the cash flow statement, money, right? So which shows you the cash inflows and cash outflows of the business, where they're spending the money, where they're getting the money from, and things like that. And then we also have a statement of changes in equity, which is at the moment we'll leave that on the side. It just basically shows you how the equity changed from the start of the accounting period until the end of the accounting period. So those are financial statements. Those are actually the reports you give to the bank when you're trying to borrow money. They ask for your financial statements. You to show them your numbers, and so the bank can make sure the numbers are good, and you'll be able to pay the loan back. Now, obviously, if you cannot, bank will know. So those are financial statements. A quick view of the company's position and performance of what's going on with that. Once you've done the financial statement, now comes the closing entries. Now let me explain. When we are doing accounting, we have 5 categories of accounts. We have assets, liabilities, equity, revenues, and expenses. Now, revenues and expenses, you have to understand, are temporary accounts. Means they don't permanently exist year after year. For example, let's say you're a friend who has a business. If you ask your friend, what was your revenue? Your friend will ask you, what do you mean? Revenue for this year, this month, this week? Like, what do you mean? So you'll have to specify. I mean, how much did you make this month? Okay, so the friend will tell you the revenue. That means inherently we know revenue belongs to a time period. There's no such thing as total revenue from the start of the company until now. Obviously you can do that if you want to, but that's not how it works. Similarly with expenses, if you ask your friend, what was your rent? Your friend will ask you, like, what do you mean? This month? Last 2 months? What specifically do you mean? Very important point. That's why we know expenses and revenues are temporary accounts. Means once I've used them, like in the financial statements, now I can close them, means convert them into zero. So next year I can start counting from zero again for the next year, and it just keeps going. However, we cannot close out the assets, liabilities, and equity account. Those are permanent accounts. Why? Because if you ask your friend, what do you own? Your friend will tell you, I own this house, I own this land, I own this car, I own this furniture, I own this iPad, things like that. So that's what closing entries are. It basically refers to converting temporary accounts into zero. By zero, I mean zero balance. And so that next year we can start counting from zero again to whatever happens that year. Now the last step. So, let's talk about the last step. Last step is the post-closing trial balance. Post-closing trial balance is exactly the same as adjusted trial balance. The only difference is it does not include the temporary accounts because they've been closed before it. Before the post-closing trial balance, we have closed the temporary accounts. So post-closing trial balance is literally the same as adjusted trial balance if you take away the temporary accounts. But there is one difference, which is in the adjusted trial balance, the capital account has a different balance than adjusted trial balance because when you make a profit, when you calculate the profit actually goes to the capital account, so you have to add that to make it the correct capital balance after you close the revenues and expenses and you have the correct trial balance, which is post-closing trial balance. So that's it. That's all the value I could provide in whatever time this video would end up after me editing everything out of it. Hopefully it is watchable, and then subscribe, I guess. Do me a favor, subscribe. I'll see you next time.